Okay, Mahesh Patil joins us now. Let's connect with him. Let's understand what he makes of the recent rout in some of the mid-cap stocks, and is an earnings season an indication that the best of the earning upgrade cycle is behind us. Mahesh, good morning. Thank you for joining us. These are early days, Mahesh, to talk about the earnings season. One side you've got a surprise which has come from IT, but on the other side you've got cost pressure and volume pressure which is now there in FMCG, consumer, and perhaps food companies. What is the right way of analyzing this earnings season?
Yeah, I think so. This earnings season, I think one is to look at the recovery in the top line growth because after a long time, we are getting a kind of a normal quarter. I mean, there was a fear about the third wave coming in, but it's not such a big impact over there. So key thing to watch is how things are normalizing, how the top line growth is coming in. And there was always a concern on the margins because the sharp increase in the commodity prices, what we have seen in the last 6 months or so. So margin pressure was obvious because last year we had seen the top line was an issue, but margins were better because a lot of companies were able to cut down on their costs and the operating level did much better. This time around, I think companies have shown some impact on margins, especially companies which are not been able to pass on the cost increase, and that is to some extent expected. But I think more importantly is to look at how the recovery has happened in the various segments. And there, I think it's been a kind of a mixed bag. On the consumption side, we've seen that the recovery is there, but it is not still up to the mark, which we were looking at pre-COVID levels. So, I mean, a good comparison is to see compared to 19, right? Similar quarter in 2019. And this year. So 2-year CAGR is what I think one would be looking at and to see what is the growth in each of these sectors or each of the companies and whether they have normalized. So up till now, I think results are a mixed bag, but I don't see any major change in the earnings growth numbers for this fiscal year, which is still likely to be very strong, around in the mid-30s or so is what one would expect. But again, I think that will be driven to a large extent by a couple of sectors, and primary of that would be the metal sector, where there is a sharp increase, and to some extent in the banking and financial services sector.
Mahesh, so one side of the economy is doing very well, which is metals, materials. If you are essentially a resource company, this is like a fairy tale time for you. But for the consumer companies, the pain I think is visible. It started with the autos last quarter and consumer durables are feeling the heat. Where do you think market will find its balance?
So I think you're right about that. The commodity sector, the resources companies, because of the shortages which have been there, the supply side challenges, have seen a significant increase in their realizations and strong growth in the profits. The consumer side, especially the large ticket discretionary consumption, is still slow to pick up. But I think we are getting decent size in this festive season that consumer durables and other companies are seeing a comeback. Consumers are coming back into the market and purchasing. So I think the balance would be that I think initially in the early part of this calendar year, we had seen a strong global recovery which was there. And the view was that the global cyclicals will do well, and they have played out fairly well. I think as we move forward from here, the domestic cyclical would slowly gain momentum. And as the Indian economy recovers into next quarter and the quarters beyond that, as you know, India's growth is been lagging behind the global growth by a couple of quarters because we had late second wave which came in. And to that extent, I think our growth in the next few quarters or even next fiscal year should be fairly good. A lot of the recovery plays which we are looking at, whether it's in the retail sector or whether it is in the entertainment sector or in the auto sector, I think should see a revival. Now, one has to wait and see how the recovery is, how strong the recovery is, because there has been some impact because of the COVID. There have been some incomes have been impacted. So we'll have to wait probably for another 1 or 2 quarters to see how the underlying growth is. Currently, I would say that we have slightly disappointed in terms of the recovery, what we were looking at, especially in the last month. But again, it's still early days to comment on that. So I would say a balance between domestic cyclicals or incrementally more biased towards domestic cyclical going forward should do probably well.
Are you worried about the price points at which, let's say, IEX, IRCTC, DMart, some of these so-called quality stocks are trading at? And do you fear that the kind of casualty we've seen in some of these stocks earlier this week, that could sap the market momentum, that could have far-reaching market if these crowded trades, they start reversing?
So you're right. I think there has been some amount of exuberance in the last few weeks or months, I would say, especially in some of these stocks, which are typically high growth stocks, which are high growth sectors. And there, the valuation expansion, which I've seen, has been huge. And I think it's a combination of, I think, retail money, which has come into that space. I don't think it is too much of institutional buying, because institutional investors are probably more conservative, okay, when they look at some of these names and valuations, like we would. And to that extent, I think there's some bit of caution over here, because when the tide turns around, you should see some of the retail investors probably who have leveraged and bought into these stocks could see an unwind of that. And that's what we saw in the last couple of days. And so, but again, if you look at the broader market, if you look at the larger market or the Nifty companies, I don't see that kind of exuberance over there. There's no doubt that the market valuations are expensive compared to historical levels, but there is still comfort in these names based on their fundamentals in terms of their growth. So I mean, there could be probably some correction in the side market, some of these small caps, mid caps, where or some of the large caps also, okay, where we've seen excessive valuation. But the larger frontline names, I don't see a very large correction. Obviously, it will be driven to a large extent by what happens globally. And if there is a correction globally, and we are seeing some signs of nervousness over here at these levels, I think our markets could fall to that. But that should not be such a large correction for investors to be too worried or panicky about. But clearly, in individual names, stocks which have rallied without fundamentals, especially in the last couple of months, I think one needs to be careful.
Mahesh Patil, good morning. So in the stocks that have run up, you're saying the fundamentals were not strong. What are the lessons to be learned? Because is it also a fact that now, investors are thinking this company can also be a platform company, this company will also have network effect, and they only realize later that the terminal value is not what was conceived or envisaged?
So I'm not seeing these companies are not fundamentally strong. I mean, there are some fundamentally strong companies, but the question is, what is the right price to pay for that, right? And this is, we are in a bull market, right? So people tend to build scenarios, okay, scenarios and outlook, okay, which goes beyond what we can see in the next 8 to 3 years, and taking a longer term view, where a lot of assumptions can go into it, and depending on the assumptions in terms of your growth, discount rate, that can change the value too much. And as you go more, a stock, current value of a stock is consists of two components, right? One is the terminal value, and one is what is the explicit discounting of cash flows you're able to do for the next 5 years or 10 years. So as you have more and more value coming in from terminal value, right? Say more than 60, 70%, 80% coming in from, then there is a worry, because any change in the outlook, growth outlook, or any change in the assumptions can lead to significant change in the valuation. And that's why I think one needs to be careful in some of these names when you're trying to build those assumptions. In a bullish market, everything looks good and people are more comfortable or giving a larger leeway to some of these assumptions. But I think you can have some of these, because these are some of these stocks are long-term growth compounders. But I would say that this is a market, and looking at the valuations, one should exercise caution. If at all one wants to participate in some of these growth stocks, I think one should do it in a limited way. and not take excessive exposure. Only thing which you can digest and hold on for long term without unable to withstand any large drawdowns in some of these names if there's any volatility in the markets.
So as you sound this gong of caution, Mahesh Patil, is it only based on the valuation run-up, the PEs, the EPS that a lot of the market participants are now finding it hard to digest? Or are you also sounding this gong of caution because what's happening globally? Look at the US bond yields. A lot of experts are saying they're watching that more closely than for Qs back home in earnings season. The global crude oil prices, the way they're heading up.
So I think US bond yields have gone up again. Some concern about the inflation, which we have seen is slightly higher than the expected rate. And that has, and bond prices anyways had corrected. But I think they are nowhere levels when one needs to be too worried about. They are at levels which are normal levels. And I don't see, that could lead to some amount of short-term volatility. And that's quite natural when we've seen sharp one-way rally in the global markets, also just like what we've seen in India. But I don't think from a long-term investor, I think that should be too much of a concern. I think any recovery, any increase in interest rates or bond yields will be driven by the underlying growth assumptions. If underlying growth outlook improves, then one could see that going up, which would not necessarily be bad for equities, right? Because equities do well, when the growth outlook improves. Even if there is some increase in interest rates. There is some adjustment which happens, when there are some large moves in the interest rates and the bond yields. But after that, market again assumes the normal trajectory in terms of the overall growth in the economy. So while it is need to caution at this point in time because the way the run-up has happened, and there are some of the events which are there in the next couple of months, we'll have to see how the Fed does in terms of the tapering. And there could be some period of uncertainty and volatility which could come in. And to that extent, clearly one needs to have a cautious view over here. But that doesn't change the longer term outlook on the market. I think that still remains fairly, we're still in the bull market is what I would believe.
Right. Mahesh, so what's the word out for investors right there? Buy into declines into the high beta pockets which may arrive? Because, these are good growth companies, whatever may be the concern around valuation, that aside, or the steep run-up for that matter. Or would you say wait it out, see how long the correction persists? Because, for instance, today we're seeing a dead cat bounce.
So I think from investors' perspective, I would say that it's very difficult to time the correction. We would have thought that a couple of months back, one would see some correction in the market, but that market has belied that. And one doesn't know. But I think I would say that at this point in time, don't be aggressive in the market. Don't try to chase high beta because whenever there is volatility, you see a larger correction over there. Invest definitely. I think this is the market to invest into declines, and I don't know what the level of correction could be, but any declines here closer to around 8 to 10% should be a very good correction to really buy into this market. The overall outlook in terms of improve, because I think especially from India context, we are, if you look at the economic cycle where we are in a kind of expansionary phase, right? We have come out from a bottom, and this phase could last for a longer period of time, where the market has run ahead. So I think that gives a lot of comfort that this recovery in corporate earnings and growth will continue for a few years, and one would want to really benefit out of that. So clearly buy on dips, I would say. I think this is a time where we remain more on the well-established large cap names, because that's where I think there'll be much more stability at this point in time. And selectively, I think one can look at the mid cap and small cap space, because if you take a 3-year view as the domestic economy expands, there could still be a decent return in that segment. But this is the time to take out some risk from one's portfolio And that's what we are also doing in our funds.
So at a time when there is so much uncertainty, Mahesh, and like you said, no one can time the market to the T, are you safer off with large caps, or would you say, stay put with mid and small caps? This correction, if at all it gets deepened from here, don't know the extent, but these stocks will resurrect at some point.
So I would say that you maintain the right balance in your portfolio. Don't go aggressive or in a particular segment. There could be some bias towards large caps or multi-cap kind of a portfolio if you're looking to invest in the mutual fund side, I would say at this point in time. But as long as you have the right balance, the right mix of mid caps, small caps in your overall portfolio, I think that should be fine. I think one can't keep on changing the portfolio because structurally, I think we are still in a trend. So there's no reason to really make any big alterations in portfolio as long as you have the right allocations based on your risk profile, I would say. But incrementally, I think if you want to make any allocations, then at this point in time, I would suggest that the large cap names is where the larger allocation should be.
Mahesh Patil, appreciate your time. Thank you for joining us. And guess what, folks? What is reversing?